Hey everyone, welcome back to the channel. And today we are discussing the top ways to lower your payment when purchasing a home here in Maryland. Hey everyone, welcome back to the Living in Maryland channel where we discuss all things living here in the great state of Maryland. So if that's the kind of information that you are looking for, then you are definitely in the right spot, and we really appreciate you being here. And if you are thinking about buying or selling a home here in Maryland, or if you're thinking about moving here to the area and you'd like more information and you'd like to have a conversation about that, we'd absolutely love to help out in any way possible. So however you feel most comfortable reaching out, whether that's by phone, text, or email, days, nights, and weekends, we've got your back when moving here to the great state of Maryland. All right, so today, as mentioned, we are discussing the top ways on how to lower your monthly mortgage payment when purchasing a home here in Maryland or as a homeowner here in Maryland. So the first few things that I'm going to talk about are really kind of around financing and things to keep in mind when discussing financing leading into the home purchasing process. The other ones are going to be more overall miscellaneous things that you can do as a homeowner that may help get that monthly payment lowered. So first off, we're going to jump into things surrounded around financing. And the first one is going to be what's called a 2-1 buy down. This is something that's newer to the marketplace, but when interest rates started rising, this was something that came about from the lenders, and it's definitely something to consider. So what it is for the first year of having your mortgage, the interest rate will be 2 percentage points lower than what the going rate is. And then the second year into that mortgage, it'll be 1% lower than what the current mortgage interest rates are. And then in the third year, it jumps to whatever the rate is when you lock while you're under contract to purchase that home. And this is something that needs to be paid by the seller. So it's something depending on the marketplace, depending on the supply and demand, and how that looks like on the property that you want to pursue. This could be something to utilize. If it's a competitive situation, getting the seller to pay for the buyer is going to be very difficult because it can be costly. It can be upwards of 2 to 3% of the purchase price. So, and basically what it is they're just taking the difference between the monthly payment at the market interest rate and then the reduced rate, and they're just kind of like lumping all that together. And then that's kind of how they come up with this figure. So again, depending on the marketplace, depending on the demand for the property that you're looking to purchase, I would definitely ask your realtor about this. This is something that we're definitely seeing utilized in the marketplace. If the property's not super, selling super fast, and you can have a little bit of negotiation with the seller to get them to pay for this. Now, this 2-1 buy down is not a permanent solution, but it is something that can help for the first 2 years of getting into the home, and then just, kind of getting your feet under you. And then depending on where rates go, that gives you time to refinance. So again, it's something to kind of keep in mind that it's not a permanent thing, but it is something that can help ease the payments in the beginning. So something to think about, something to talk about and look more into, but definitely something that can be utilized here in the marketplace today. All right, next is what's called a PMI or MI buyout. PMI is private mortgage insurance. MI is just mortgage insurance. If you go FHA, they call it PMI. If you go conventional, they call it MI, but it's really the same thing. And all this is the buyer purchasing an insurance policy to protect the bank if the borrower is to default. So it basically just it exposes the banks a little less. If the buyer defaults and they have to take back that property, they're going to get a payout from an insurance company, and it's going to make it to where they're a little more protected and they're less exposed to losses if they have to take back that property. So that's all PMI or MI is just protecting the bank against borrower default. Now, anytime you put less than 20% down, there's typically some form of this, whether you're paying for it through the interest rate, whether you're just straight up paying PMI. Sometimes they call it lender PMI. So there's all sorts of things and all sorts of different names that they call it. So if you're putting less than 20% down, just be aware that that's almost certainly something you're paying, and making sure you're looking into that, because sometimes the names can change based on the type of loan that you are doing. But MI buyout is if you are going conventional, because FHA does not allow this. So this is something specific to conventional. And if you're putting less than 20% down, you're going to have some form of MI. You can do a one-time buyout of that mortgage insurance. You can ask the lender to give you a calculation. It's something that's not super easy to come up with because it's going to depend on credit, how much you're putting down, overall kind of loan situation of the borrower. So definitely something to ask your lender about. And it's something we've been doing for years, but especially now with higher interest rates, with affordability just being tougher, this is something to still consider, especially if you can get the seller to pay for it. Or it can still be advantageous as a buyer to even pay for it yourself. So what I tell people is, if you want to consider this, look at what 20% down is, payment and cash out of pocket. Look at 10% down, payment and cash out of pocket with the buyout, and kind of see how those weigh out. And a lot of people find it beneficial to go with 10% down or just less than 20% down, doing an MI buyout where the payments not significantly more than putting 20% down, and then it can be something that can definitely be beneficial and help you keep more money in your pocket, which is something that's always helpful in this environment. So something to keep in mind when you're looking at loan options, that this is definitely something you can do specific to conventional. And that's why I love conventional, because it gives you so many options when it comes to using that type of financing that other types of financing don't give you. So look into that. If you have the ability to go conventional, look into what it would look like if you're to buy out the MI and how that might assist you in purchasing a home. All right, next is good old-fashioned buying down the rate. Now, this is something where if you're paying for it as the buyer, you're really just prepaying interest, so it doesn't really help you all that much. But if you're in a situation, or if the market is allowable to this, where you can get the seller to pay for this, this is something that is definitely worthwhile looking into, where we can get and request a seller contribution from the seller within the contract to give you a credit to pay for buying down the rate and getting the rate lower than what the current market interest rate is. So this is definitely something to keep in mind too, as well as you're looking at properties, as you're looking at how quickly they're selling. If it's something that's not flying off the shelf and there's some room for negotiation, this is something that I definitely like to keep in mind with buyers, where we can ask the seller for a credit to pay for some points to buy down that interest rate and make that payment a little more affordable each month. All right, next is going to be considering an ARM, or what's called an adjustable rate mortgage. Now, this is definitely something you want to look into. It's not something to take lightly. It's something you really want to understand how it works, because it's, just like in its name, it's an adjustable rate mortgage. So anytime you see this, if you see what's called a 5-1 ARM or a 7-1 ARM, the way that this works is that the first number in the name is going to be how long it's fixed for. So 5-1 ARM is going to be fixed for 5 years, and then every year after that, it can adjust based on where the federal funds rate is, or the prime rate is. So if it's 7-1 ARM, then it's fixed for 7 years, and it can adjust every year after that based on where the prime rate is. So they also have 3-1 ARMs. So you just want to be aware of how these work, but if it's something, it depends on your risk tolerance, right? So this is something that I tell people. So when you're looking into this, if you are confident interest rates are going to go down, and this helps you, lower that payment, because when I'm looking at a local credit union that I work with, if I was looking last week, if market rates for conventional were around 6%, the 5-1 ARMs with this credit union were about 4.875. So it's saving you over a full percentage point for those first 5 years while you kind of get into the home, and then figure out what the next best move is from there. And it just kind of gives you some time to see where things are going and what might be the next best opportunity, and kind of where to take that loan from there. But something to definitely look into. Maybe you're not even going to be in the home that long, so that's something that could be beneficial. So just kind of depending on the situation, this can definitely be something to look into. Now, with adjustable rate mortgages, I cannot speak for all of them, but at least for the ones that I've been working with the local banks here, they are fully amortized loans, which means each month you're paying down principal and interest. It's not like a balloon or an interest-only type of loan. It is fully amortized, so that's something to keep in mind as well. So I wanted to clarify that in regards to adjustable rate mortgages. All right, so those were all the items to consider when you are looking in the initial stages of getting financing for a home. Now, the next 3 items that I'm going to mention, these are more just overall broad things to keep in mind, not necessarily specific to financing. So first one is going to be the location and the county, more specifically, that you look in. So depending on what part of Maryland you're looking in, the counties are going to have different property tax rates. They're not going to vary drastically, especially in the suburbs, but they may vary, a little bit. Now, if you're comparing like Baltimore City to Anne Arundel County or to any of the counties, they will vary more significantly. But if you're comparing, county to county in the suburbs, they're not going to vary drastically, but it could save you a little bit of money if you were to look in, say, part of Anne Arundel County versus part of Howard County. So kind of keeping that in mind if you're open on location, looking more into the counties and what their property tax rates are and kind of seeing what that looks like and what might save you some money. So for example, in Howard County, there's a popular area called Columbia. Columbia's got Howard County property taxes as well as a city tax. So when you look at property taxes and overall taxes tied to the property in Columbia and Howard County versus say a town in Anne Arundel County, there could be a significant difference there of maybe $1,500 to $2,000 a year. So something that can definitely help you save some money each month. All right, next is identifying if the property has an HOA and figuring out exactly how much that costs and what that looks like. And this may not be, again, something that saves you bundles of money, but it could be something that could help out a little bit month to month. So your common HOAs out here, depending on the type of property, could range anywhere from $50 a month to around $150 a month. So kind of identifying what that looks like, if it's important to you to be in the neighborhood that may have the HOA versus being in a neighborhood that has either a lesser HOA or no HOA at all. All right, next is going to be shopping your property insurance, or also called by lenders a lot of times hazard insurance, once you get a contract on a home. Now, this is really one of the things you can shop for once you get a contract on a home. With the lender, they're going to ask you to provide evidence of hazard or property insurance once you start going through underwriting. So this is something definitely to keep in mind, and shopping can definitely help. So I always tell people, you can start with where your auto insurance is, and then making a few other calls can definitely be helpful. And probably one of the biggest things that can swing your monthly premium with the insurance company is what your deductible is. So this is something that definitely can come down to risk tolerance as well, how much you're comfortable paying out if you were to file a claim. So just kind of having that conversation, thinking about what that looks like. You can have up to a $5,000 deductible, and I think you can have as low as $500 or $1,000 deductibles. So naturally the premium's going to be lower the higher your deductible goes. So if you are handy, if you have really never filed claims before, and that's something hopefully you would try to avoid at all costs, maybe considering the higher deductible and kind of saving money monthly and annually with your homeowner's insurance is something to consider. So definitely making a few extra calls, getting more than one opinion on that is something that's very helpful. Now, when I switched a couple years ago to someone local here, I worked with a broker here locally in Maryland who shops several different companies here locally in Maryland to get you the absolute best coverage for the best rate. So for me, I saved a little bit of money monthly, but I got almost double the coverage when I started shopping, and I got much better coverage. Even though I wasn't saving a ton of money monthly, I did save a little bit, but I got so much more coverage for the price. So this is something as well where you can maybe make up some ground. So keeping that in mind as you go through this process can be very helpful. All right, everyone, thanks so much for watching. I hope you found this helpful. If you ever have any questions about buying or selling a home here in Maryland, please feel free to reach out anytime, and we'll see you at the next video.